Really, one of the fundamentals of real estate is to replace your income through growth. And if you're buying just cash flow, it obviously pays for itself. But you want, at the end of the day, to wake up in 10 years' time having bought $1 million property and it's worth $2 million. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into 9 key property trends which are influencing the property market right now. There's certainly many things happening, and today I want to sort of cover off on some of the trends which are out there. I spend a lot of my day out and about seeing property and understanding what's popular and what's not. And so certainly when it comes to what's trending, we can go over the good, the bad, and the ugly of what's out there in Australian real estate. Welcome back, regulars. You know the drill. Play the program in double speed, get your life back. And of course, all the episodes I've done are actually lessons on real estate. But hey, I don't know. I've got an unemployed dog, apparently. I spoke to a wise dog master about Rafi's behavior, and apparently he's unemployed. He actually has no job. He simply lazes about. He's either asleep or he's playing games, and I've got to give him a job. So if anyone knows what jobs you can give a dog, I am very open to hearing about it. Apparently I should be making him do perimeter searches of the house, sitting on mats and obeying. But he just sits upside down all day and basically snoozes and then wants to play ball. So yes, many of you probably have unemployed teenagers. I have an unemployed dog. But let's get into it, because I've got to go play with my unemployed dog. And there are some key trends out there in the Australian property market. And of course, probably the most notable trend at the moment is the rise of property prices. And it's very interesting when you analyze the real estate market across a longer term cycle. And of course, real estate has a longer term cycle, the 18-year property cycle. During the 18-year property cycle, really, you can divide it into places in Australia that perform early in the cycle and those that perform late in the cycle. And right now we are late in the cycle, late in the 18-year property cycle. And generally the smaller markets do very, very well later in the 18-year property cycle. Remember, this cycle began effectively in 2008 and will run its course by the end of 2026. The markets which come late in the cycle are generally places like Adelaide and Perth, which are small markets inside of Australia, because most people live between Brisbane and Melbourne, and the landmass around those areas and out towards the eastern seaboard. So it's very interesting, the rise of property prices when it comes to the trend of the 18-year property cycle. It's doing its thing. The smaller markets have dominated over the last couple of years. But if we cast our mind back to the start of the property cycle, the 18-year property cycle, it was really the marketplaces of Sydney and Melbourne which kind of dominated the headlines. And it's probably fair to say that as we drift closer to the start of the new property cycle, the next 18-year property cycle, the growth may just again trickle down to another marketplace. And a lot of commentary is certainly around the Melbourne market being the next one that has the most validity around it when it comes to pricing. And so, and I certainly think Sydney's got some legs as well, despite its high prices. the cure to high prices is higher prices. A lot of property investors can't afford Sydney. They're extinct from the marketplace, but a lot of growth can still happen in that marketplace despite the lack of ability for a lot of investors to get into the market. So it's interesting where, drifting closer to really a new 18-year property cycle. And that means we should actually see a rise in prices down the track of marketplaces which have sat out of the tail end of the 18-year property cycle. And generally, they're the big marketplaces that kick off a cycle, which is Sydney and Melbourne. So we'll stand by for that one. But the rise in property prices is now also across the board. Every market is doing quite well, and every market is gaining in value, not losing in value. And therefore, as long as you're in the market, right now, trend is equity creation. People are making more money just owning real estate than even going to work in many marketplaces. And so certainly there's no signals that long-term confidence in the property market is not there. It's basically another year and more growth. That's what you have to say around that trend. I don't know anyone who's betting against just more growth. Will it be exponential growth? No, but it's going to go up in value. So that's trend number one. And that trend helps me pay for my unemployed dog, because whenever real estate goes up in value, we all feel wealthy. And that means you can buy your unemployed dog's expensive balls from Pet Barn and, throw them to him. But there is other trends out there, and certainly what I'm seeing is the focus around energy efficient properties. And I've spoken about this before. I think it's important to future-proof yourself against regulatory change. I don't know when some madman's going to get into power and make every house in Australia have a windmill. But certainly if you've got energy efficient real estate, 6, 7, 8-star NATAs rated, you're going to be left alone from any future retrofitting ideas around climate resilience. So I'm all about making sure that my retirement doesn't get derailed by some, windmill politician who wants to, basically use my backyard as a wind farm. But certainly when we look at the generations that are certainly sort of below 50, below 40, there's a lot of environmentally conscious buyers and even tenants at the moment. And of course, government has been pretty strict in many marketplaces to make rental properties effectively energy efficient. And right now there's energy efficient standards for rental properties. And it's just a lot easier to own rental properties if your real estate is energy efficient to begin with. So it's a big trend out there. And I think it's just going to get bigger and bigger. You know, people not only surmise the value of buying real estate, but also the true cost of owning the real estate. And if you can lower your holding costs on real estate, you can hold it for a lot longer. So lowering running costs through sustainable, energy efficient, building practices really does help that be a thing. So right now, it is really a marketplace which, buyers do really respond to sustainability. And they want to know what's going on. They want to know if they've got solar panels. They want to know if they've got EV car chargers. They want to know, the tree count in a neighborhood. They want to know effectively the NATAS score of a property. And what's so interesting now is, of course, you can get a green loan. You know, the more your real estate scores better from a sustainability point of view, the less money it costs you to borrow. When you borrow money, you can get a reduction because there are things called Green Star loans. So certainly from a trend perspective, this is very much trending. And, you know, I see it all day, every day, just how many people actually put this as part of their due diligence checklist when it comes to what they want to buy when it comes to real estate investment. So trends are just things which can push the market along. And there are trends both that are, you know, driven off buyer preferences, but also there are trends which are happening inside of society, which, you know, are just a reflection on, you know, what's going on. And the growth in co-living spaces is a reflection in the fact that real estate, even rental properties, are unaffordable for a lot of people. And, you know, there are all sorts of people in society. And there are people who are down on their luck inside of society. And, you know, there are people who are not only down on their luck, but, you know, have all sorts of conditions and issues and mental illnesses and criminal histories. And so co-living is a dynamic which has been brought to the Australian property market, which effectively allows people to rent a room, a shared tenancy arrangement. And really, when you look at the co-living environment, it's driven under what is known as a rooming house legislation. And sometimes rooming house, people don't use the word rooming house because they're marketing it as co-living. But really, it's a boarding house, if you like, to use a term from the 80s. Now, when I first got into real estate, I used to look after boarding houses or rooming houses. And I guess I've always been scarred from that experience because rooming houses and boarding houses were basically places for people who were virtually homeless to live in. And, you know, they would struggle to pay the rent. They would get their Centrelink money and they would, you know, effectively, pay a minimal amount of money to live in a room where they shared a bathroom, where they shared really the kitchen. And, yeah, they clustered together. Now, I did that in Glebe, and today in Glebe, there is still many a boarding house there where people sort of cluster together. And, you know, it's not glamorous. It is not glamorous. And, you know, when you're sort of living with strangers and you put 5 strangers together in a boarding house, it's just not glamorous. And so sometimes co-living is kind of painted as this kind of like, we'll get, you know, 4 doctors and they'll all share a house together and pay an exorbitant amount of rent. Well, you know, maybe that's 1 out of 1,000, but generally co-living or rooming houses quite often designed around the idea of the less fortunate banding together to live together. And you can get obviously high yields from, you know, getting rent from a room by room situation. But rooming house legislation is different to residential real estate legislation around the rental market. You need to look after the common areas as the rooming house provider. You've got to, you've got to provide certain level of finish inside of a home, locks on every door. And one of the interesting things about rooming houses is that really the vetting of people who stay in rooming houses, they can stay as little as sort of 3 weeks if they want to. It's not designed around people staying for 10 years. It's just, really people, when they apply, can basically look for pretty simplistic accommodation for the short term. And again, like you put 5 strangers in a room in a building together, there is levels of challenges in that space. And it's not a utopia. Think about just living with your own family. It's can be, good and bad. You do that with strangers and it's going to be, good and bad. And of course, the rooming house environment is designed to really help the bottom end of town. Now, are there rooming houses where 4 nurses living right next to a hospital live inside a rooming house? Probably yes. And I would imagine that's, for those lucky people, a great investment. But as a trend, what we're seeing is rooming houses come to market, and they're designed basically as house and land packages. They've got sort of 4 or 5 rooms and not very much living area. They're basically dominated by the bedrooms themselves, and you rent the bedrooms separately. When you build the property, though, you've got to make sure you've got a Class 1B interconnected smoke alarm, cameras, meter upgrades. You've got to have, different fire ratings, different soundproofing ratings. You've got to have different exhausts put in the home, digital locks. You got to have more wet area and disable access points, double glazing, so it's a bit more soundproof for the neighbors. And so it's a completely different home than just the idea or the romantic notion you just get 4 people sharing a home and, each of them pays you rent for a room. So there's a bit more to a Class 1B rooming house, but it is a bit of a trend at the moment, certainly from the desirability to create cash flow in your portfolio. And, some of the returns are, pronounced as quite high, but of course, then you got to own this thing, look after it, look after people coming and going, pay money to re-rent properties or rooms because that it hasn't worked out. But the big challenge with the rooming house, and certainly from a trend perspective, you would only do it for cash flow, because the growth on the rooming house may be circumspect, because the way it's designed, it's really not designed for a family to buy the house, because it is a cluster of bedrooms as opposed to spatially in the home where you've got more living and dining space. The living and dining room is kind of absorbed to make a little bigger bedroom. So would a family come in and go, I'm going to pay you double the price for the property because we're emotionally connected to the real estate? The answer is no, because the layout of the home is just not designed that way. It's designed to just be room by room by room. Will one day someone go, I want to buy a cash flow positive property and a rooming house is my vibe? Absolutely. And I've had clients do this and more do it as a trading strategy, buying and getting it rented and then selling it and make a quick buck. I think Katrina, shout out to you. I know you pulled that off. But as a sort of nuanced strategy, you've just got to be mindful of the good bits and the bad bits. And probably, I'm highlighting some of the risk So, just, there's probably some good things as well. But certainly from a risk perspective, it's something that, certainly when I'm negotiating real estate, I'm just mindful of the liquidity, because really one of the fundamentals of real estate is to replace your income through growth. And if you're buying just cash flow, it obviously pays for itself, but you want, at the end of the day, to wake up in 10 years' time having bought $1 million property and it's worth $2 million, because that's going to be a lot more than the extra $5,000 a year you get from a rooming house. So it's just something to consider, It is definitely a trend. And really, there are other trends in real estate as well, which include mixed-use developments. And really, this is probably a trend which is becoming super popular with baby boomers with bucket loads of money. They're basically moving into pretty luxurious and salubrious apartments, which are mixed use. They will have a designer gym. They will have a hatted restaurant as you enter the building. A pretty amazing mixed development. And some of the best ones are just doing so well. They're making people so much money. But not all mixed use is doing that. You've got to also take into consideration where the wealthy want to live. And I teach a concept known as modern portfolio theory, where it's really that trophy real estate in mixed use is doing well. If you can go downstairs and you've got a awesome providor and a beautiful restaurant, living in your building is just amazing, because you're not just, I guess, in a dormitory environment, you're in a live environment. And so mixed use is doing well. You're seeing the best mixed use with beautiful restaurants, with, incredible gyms. They've got cheeky little Scotch bars in them. They've got co-working spaces. They're just doing so well when it comes to, what they're offering. I've seen buildings where there's urban farms in the mixed use, and the farming produce from the urban farm goes from building to plate in the restaurant, and residents are, part of their own ecosystem. So it is a bit of a trend at the moment, and it's probably a leading trend. Like if you were to think of like the future of real estate, a lot of it is coming through mixed use, and it's boosting property values. The right retail boosts property values in its own setting. And the challenge with the wrong mixed use is you go downstairs and there's nothing there. There's a dead, a dry cleaner, or I don't know, just a 7-Eleven or something, and it adds no value to the living experience of the building. The best in the business are providing some pretty amazing mixed use environments, and it's people are paying for that living experience, which is really the other trend which is unfolding at the moment, which is the wellness trend in real estate. As you guys know, I've kind of talked about this before, but there's rising demand for spaces prioritizing well-being. And of course, the amenities that are well-being based are just popping at the moment. And, some buildings have their own basically longevity infusion into the building. And longevity and wellness is a real thing. And I've talked about this before, the Ikaria effect of real estate, the blue zone effect. The blue zones are 5 places around the world where basically people are becoming centenarians. They're living till 100. And there is a lot of people who are part of the ecosystem of real estate trying to recreate these communities. They're creating places where people move all day, where people have a increased level of community well-being. They have just the right sort of ingredients, the right food, nutritional food, and social activities that are pushing the envelope of community. And some of them are in buildings and some of them are in places. And, these are big, big trends. This is where a lot of value is going to be created in real estate: longevity spaces, wellness spaces. We already have seen it already with the Byron Bay effect. Obviously, Byron Bay, a sort of, well-known township in New South Wales, but it's all about wellness there. And whether it's doing some yoga in the morning, to surfing at 10 a.m., to having, an acai bowl at 11, and then going and spotting some dolphins at 2 o'clock, and then doing a 6-kilometer walk to the lighthouse, and then meeting people for a cheeky dinner at the Greek restaurant and having a glass of, red wine. It's wellness. It's wellness. And there is a big, big, big premium being paid for wellness precincts and buildings. And certainly something that I'm very fascinated in. And I'm doing as much work as I can in this space, because I just think that the value's always changing. Value's not static. And, people don't want to, well, certainly, people my age or younger, and maybe, tad older, they don't see themselves basically rotting inside a house till the day they die in a suburb that they don't particularly like, in a house which is depressing. They will go and find community. They will go and find wellness. And whether that's just even leaving Australia altogether to go and, live in Canggu or something, this is really on brand at the moment. And anyone with a modern amount of wealth is searching for this. And when I say a modern amount of wealth, obviously not everyone can afford wellness community or wellness areas, but livability is a huge trend. And it's why I live where I live, because it gets a 5-star rating from a livability perspective. It's one of the most livable places in Australia. I can walk out of my house. I'm in a national park. I'm on 3 beaches. I can go for a walk to a green space park, which is not a national park. It's just a basically regular park. It's wellness, and whether it's wellness precincts or even a building today is re-emulating wellness, creating its own green zones, biophilic nature inside the building, which is, that sort of creative wellness space, to having some incredible fitness equipment inside of buildings. So it's big. Probably the next trend, which is really unfolding at the moment, is the rise of second-tier real estate marketplaces. And, some of those marketplaces are growing in value right now. And again, when we think about the 18-year property cycle, probably in year 18 and year 17, which we're in at the moment, you start to get this kind of, geez, there's nothing left in Australian real estate that's affordable. And so you're starting to see some of the, last choice marketplaces, second tier marketplaces rising in value. Darwin, Townsville, and, I've obviously got people in those areas that I know, and I'm not trying to be disrespectful, but it's just the way these type of marketplaces tend to unfold. They tend to be the last to appreciate in value. And, it is what it is. Everything's a cycle, and it's the rise of the second-tier marketplaces. Do I want to invest in those second-tier marketplaces to make a quick $100,000? I don't need to. Do other people who are just starting out in real estate? It's completely up to them. I think taking a more long-term holistic approach is better, but that's my own bias. It's just the way I think of things, because I know when those marketplaces subdue, they go quiet for a very, very long time. And it takes the next iteration of the 18-year property cycle to do its thing. But lower entry points is what it's all about. And again, like some of the people buying there are 25 years old, and, they're trying to make a buck in this world. And I completely get it. They haven't had three property cycles unfold underneath them to build their wealth. So when they hear me say that, I wouldn't do it, well, I'm coming from a perspective of already making wealth out of real estate. But for young people, there's the rise of the second tier market. And if you look at the marketing going on at the moment, it's generally on social media, on platforms where 25-year-olds hang out. And, there's the demonstration of the deal of the day in Outer Townsville, which is popping. And if you get enough you get that sort of Metcalfe's law effect of basically the network effect. If you can bring your network into a marketplace, you can push the values of that marketplace. And, there's definitely a bit of a network effect going on with 20-year-olds buying in basically second-tier marketplaces. So the trends that are out there are some interesting trends around leverage. And of course, today there are multiple lenders, and I would say leverage is healthy at the moment. You can go to banks which you've never heard of and borrow money. Australia is very, very blessed when it comes to the amount of lenders available in the market at the moment. And so we're certainly not at a point where there's tight leverage. So leverage is on trend. You can go to a bank. If you can service, you can borrow money. Now, obviously, the big four banks, ANZ, Westpac, Commonwealth Bank of Australia, and, of course, the National Australia Bank, generally have really good sort of valuations associated when you borrow money off them, but they have kind of lower leverage when it comes to servicing. They have higher challenges to borrow money from them. But then you can go to, for example, like a First Mac, and when you're borrowing money off First Mac, you can get high servicing. But of course, the odds of you ever paying off that loan that you buy from First Mac is very, very low. And it's just an instrument. It's a financial instrument to use to refinance later. So I don't know anyone, for example, with a First Mac loan that's ever done the 30-year loan term. Typically, the loan term is just an instrument to get into the market. So typically, whenever I've borrowed money off a Mac, it's been for about 4 or 5 years max. And then I refinance out to another lender. But quite often with lenders like First Mac, because, valuers and the industry knows it's just effectively a tool to get into the market. Quite often when you're borrowing money off that, it's because you can't go to a major because the servicing calculations are different. And so, you might be able to borrow $500,000 from NAB, but when you go to First Mac, you can borrow $900,000. How does that work? well, that's why you have a broker. But the $900,000, the odds of you paying off that loan is very low. So it's just a tool. So leverage is a tool, and there are banks still out there that have higher servicing than others, which allow you to buy effectively more real estate using their leverage. Sometimes the valuers will look at the lender and go, well, this person's over servicing because effectively they're getting double the servicing rate than they would through a major. I'll just manage my risk by lowering the valuation on the asset. So it's just the game we play. High leverage, lower valuations, low leverage, better valuations. That's basically how it works. And so, again, the leverage in the Australian property market is on trend. You can get good leverage at the moment. It could be better. There is a buffer which is currently in place, which is imposed by APRA, a 3% buffer. And there is a bit of investor lending going on at the moment. It's, may actually, from a regulator's perspective, maybe there's a bit too much investor lending going on. So I can't see them dropping that serviceability rate. And so all that means if you can borrow money at 6% from the bank, they have to assess that you're borrowing money at 9%. So because the regulator imposes a 3% override, which basically is if it's a protection mechanism if interest rates do rise in value again. So, there's leverage out there, whether you want high leverage from a MAC or you want basically better valuations from a major. It's completely up to you. It's really how the game works out there. So some other trends, which I think is pretty amazing, is there's not a lot of stock on the market because people are staying in their property a lot longer than ever before. People are holding real estate for a very, very long time. And a lot of it has to do with the simple factor that stamp duty exists. If you buy and sell real estate, you lose money through stamp duty. When your real estate becomes worth, $2 million to go and buy another piece of real estate for the equivalent amount, you're going to lose 150 grand in stamp duty. So for a lot of people, they just park it. And certainly when real estate was less expensive, the tax would not creep up. And so people moved real estate. They moved around more. But interesting, we've had a basically period of ownership that has lengthened. It's gone up by about 23%. People are holding real estate a lot longer. And this means less stock comes back on market, which of course means for demand, there's less properties to choose. Now, I was listening to a market commentator the other day, an expert on data with real estate, who kind of concluded that right now in 2025, there's less stock on market than there was in 2010. But there's something like 6 million less people back then than there is today. And how does that work? Why is that a thing? Well, people are having to hold real estate a lot longer. And of course, this in itself means there's less properties to buy. And of course, quite often that can create a correlating effect that you have to pay more to get into the market. Now, previously, it was about 8 years people held real estate. Now it's over 11 years, with some suburbs, 20 years people are holding real estate. So less turnover, fewer opportunities for buyers. And then, of course, that creates capital growth because for the people holding, they hold the trump card, so to speak. And really, the final trend, which I'm seeing a lot at the moment is build to rent. It's a real thing, whether it's a good version of basically mixed use development or whether it's pretty nasty build to rents out there. And there are some build to rent schemes at the moment where the build to rent becomes social housing and the developer is doing a mixed version, build to sell and build to rent. And so you've got a build to sell building next door to a build to rent building. And guess what? It's not good for the build to sell building, which is basically sold to the real estate market. And you're getting sort of institutional money from super funds going into the build to rent sector. And they're basically analyzing a development site now going, well, we'll do half as build to rent. In other words, we will hold it and rent it, or we will sell it to a government department for social housing. And then we've got half the development, we will build it and sell it to the marketplace. And so it's really an interesting space, and it is definitely a trend which is going to continue to be a thing. There will be less real estate produced because a lot of it will, when it is produced, is going to be held back as a rental property for an institutional investor, which is not a bad thing. I mean, it's just three versions which are unfolding in the build to rent space. You have build to rent, which is being held by corporate, which just is part of the normal rental marketplace. Then you have build to rent, which is on-sold to a government department or quasi-government department, which is build to rent social housing, which is effectively a modern day housing commission. And then you have build to rent to affordable housing. And really they should change the word build to rent to key worker housing, which is like, a suburb needs key workers like ambulance drivers, police officers, firemen, nurses, and really, there's properties built for those key workers. And really it's the social housing, which you probably want to avoid. The other ones next door to you, just like regular tenants. But a lot of it is, you only know through due diligence what's going on out there in the world. So they're the trends, folks. Hope that was worthy of your time. I will leave it there and we'll come back next week and talk some more real estate. Take care. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.